Hello, everyone. I'm Bob Goulder, contributing editor with Tax Notes. Welcome to In the Pages, where we take a closer look at some of the content from our print and online publications. Today's topic is quite timely given that IRS filing season is just around the corner. Our featured article is titled The Inflation Reduction Act's Impact on Tax Compliance and Fiscal Stability. The authors are Natasha, Sarin, and Mark Mazur. Ms. Sarin is an associate professor at Yale Law School in New Haven, Connecticut. And Mr. Mazur is the former director of the Urban Brookings Tax Policy Center in Washington, D.C. Now, both of them served in the Biden administration in the Treasury Department. Ms. Sarin as counselor for tax policy and implementation, and Mr. Mazur as assistant secretary for tax policy. And we are delighted to have them on the show today. Natasha and Mark, welcome to In the Pages.
Thank you
for having us.
So I find it regrettable that the IRS has been defunded over recent years. I really think this did U.S. taxpayers no favors. Now, the Inflation Reduction Act comes along and it tries to reverse this trend, providing a boost of funding of approximately $80 billion. Spread out over about a decade. The CBO has estimated that this new investment is going to increase federal tax receipts to the tune of about 200 billion gross. It's about 115 billion net of the outlay. However, not everyone agrees with those figures. Your Tax Notes article, for instance, puts that number significantly higher. You anticipate that revenues are going to go up by about 560 billion gross or 480 billion net. That's more than double the CBO's estimate. So what explains this variance? Can you work us through that? Explain what factors are at play.
Maybe I can start, Bob, and then Mark can let me know everything I missed. I think this sort of big picture point to bear in mind as you're thinking about the revenue potential of some of the investments that have been made recently in the Internal Revenue Service is that the tax gap, the difference between taxes that are owed to the fisc and taxes that are ultimately collected, is incredibly significant. It's about 3% of GDP on an annualized basis. Over the next decade left unaddressed, we're talking about $7 trillion that are owed to the US government that won't be collected. And so as you think about the potential of investing in better enforcement, particularly in areas where the agency has simply not had resources to pursue evasion historically. So over the course of the last decade, audit rates of millionaires have dropped off by 80%. Audit rates of large corporations have dropped off by 50%. The agency just simply hasn't had the people or the tools or the technology to be able to do this type of work. The problem is very large, and so the revenue raising potential is very large. And that's kind of what motivated Mark and I worked on this when we worked on this set of issues when we were in government, and we were kind of motivated to write this paper in part because we thought it was really important to examine the question of like exactly what can we expect or what can we hope for from these investments. And there's a host of reasons why we differ from official scorekeepers with respect to what we think the revenue raising potential is here. The one that I want to make sure to emphasize is that we just have like a bit of a different conception informed very deeply by the academic literature in this space about what the taxpayer behavior or deterrence effects are going to be of investing in a very substantial increase in IRS enforcement activities. And like the logic is pretty obvious, which is that if you watch your neighbor get audited, or if you yourself get audited, in response to that increased enforcement activity, you're going to adjust your behavior affirmatively. And historically, official scorekeepers have actually said, like, they haven't scored deterrence effects. They haven't even incorporated the impact of this type of taxpayer behavior on revenue estimates. Recently, they've started incorporating that effect, but it's very small relative to what the academic literature tells us is like hugely significant. A recent paper by Nathan Hendren and co-authors says that at the top of the distribution, those deterrence effects are like 12 to 1. Treasury has previously said those deterrence effects could be like 3 to 1. In our paper, we use corrections that are even lower than that, and that drives a very significant sort of part of the disparity between us and where the official scorekeepers have landed on these questions.
And just to add to that, a couple other factors that come into play here. One, we have more optimistic view of the returns on investment than the official scorekeepers have. Basically, the IRS, when they've looked at this historically, has said that their return on investment ranges from like 3 to 1 to 20 to 1, but it averages about 4 or 5 to 1. And so we use that as our baseline, which looks a little bit higher than what CBO and others use. In addition, we look at investments in IT and service as also having return on investment. And so when the IRS will upgrade its IT systems, they'll be able to do a lot more with that information, and that will increase overall compliance. Some people will do it voluntarily. Some people will be audited because of these upgrades and change their behavior. In other cases, just getting service will help people become more compliant. They'll be able to ask the IRS a question, get an answer, file a return with that answer incorporated in it. And so that'll have a beneficial effect as well. And these are effects that we incorporate and official scorekeepers tend to leave out. And I guess one last point is official scorekeepers tend to think there's a diminishing rate of return as you increase enforcement activity. And as Natasha pointed out, the IRS has been so underfunded for so long that they are so far away from where those diminishing rates of return come into play that they really don't have a substantial effect in the budget window at the scale that we're talking about of IRS investment.
Now, unfortunately, Congress has rescinded some of this funding. Personally, I think big mistake, but whatever. How does that affect your revenue estimates?
Yeah, and it's actually another one of the reasons why Mark and I were keen to write this paper is it's not like this investment was made in the IRS and sort of go forth over the course of the next decade. The agency finds itself in the midst of deeply politicized battles over what its funding levels should be. And those battles have already resulted in the rescissions that you're describing, Bob. And frankly, there are going to be debates on the horizon, particularly with respect, they're on the horizon right now, particularly with respect to the base levels of funding that the IRS is going to see, in addition to this mandatory pool of money that comes from the Inflation Reduction Act, that make exactly that question like extremely first order. And we actually revised this paper over the course of the last several months to include the estimate of what the Fiscal Responsibility Act, the sort of side deal negotiated to take $20 billion of enforcement funding from this $80 billion Inflation Reduction Act investment, what impact that would have on overall revenue potential over the course of the next decade. And what we conclude is that revenues are so in aggregate, revenues should rise by around $560 billion over the course of the next decade as a result of the initial $80 billion investment. If you rescind $20 billion of enforcement funds, you lose about half of that revenue. And that's because the enforcement dollars are the ones, though Mark sort of described the fact that we are sort of unique relative to scorekeepers with respect to trying to consider the revenue impact of service investments and improved technology. Really, the enforcement dollars are driving a very significant portion of the revenue raising potential here. And so rescinding about half of the enforcement funding is going to cost you about half of these aggregate revenue gains. I think that's terrible for the world, obviously, and terrible for tax administration. But a point that's important to emphasize is it also creates the potential for additional revenue to be raised as Congress thinks about tax reforms in the future, and particularly in 2025, when the tax code is going to be reopened. There is money to be had by restoring these funds to the IRS and giving them the potential to improve their enforcement activities very substantially.
Now, a few moments ago, you spoke about the tax gap, that computational difference between taxes due and owing under current law and what we actually take in. Assuming the IRS were to get all of this funding that it's been promised, would that tax gap go away, or is it something that we're stuck with as a practical matter?
So I think the the scale of the tax gap is large, as Natasha said, on the order of $700 billion a year. And that's because individuals and corporations are incredibly creative at how they respond to the tax law. And so we're always going to see situations where individuals underreport their income, claim tax benefits or tax credits they're not entitled to, and corporations do the same, where they hide income abroad or claim it's earned in a lower tax jurisdiction. And so you need to have administrative agency in place in order to kind of put a cap on that and make sure that it doesn't become infinitely large. And so what we've seen over time is that the tax gap has bounced around a little bit, but it's always around 15% of revenues, maybe in a couple of percentage point range. And so really what we're talking about here with this investment from the Inflation Reduction Act is increasing overall compliance, but only by a percentage point or two, right? We're not talking about completely eliminating the tax gap. We're talking about putting what probably most people would say is a small dent in the size of the tax gap. But it turns out to be a large number, and a small percentage times a large number gives you a lot of potential revenue.
Is it possible to view the tax gap in terms of a distributional attribute? In other words, if you look at the tax gap, can we determine where the non-compliance occurs? I mean, are we talking about waitresses that aren't declaring their tips, or billionaires stashing money in the Cayman Islands? Where do you think that tax gap is concentrated across the income distribution? Any good evidence on that?
I'll say a couple of things. I'm curious what Mark thinks here as well. One is, when I was at the Treasury Department, one of the sort of questions I was working on answering was exactly this one, which is, how can we understand the distribution of non-compliance in the economy? And there is actually there are actually very significant distributional aspects here, because when you're talking about, and they have to do with the way that people earn income, which is fundamentally different depending on the different types of people you're talking about in the economy. So when you're talking about wage and salary income, which is the disproportionate share of income that accrues to ordinary Americans, their tax liability on those income streams is both sort of reported to the IRS, because the IRS gets to see your W-2 and gets to see what you made in a particular year, but it's also automatically withheld. So there's no real scope for you to do non-compliance, because you're already paying your taxes sort of mechanically on those income streams. On income streams which are opaque to the IRS, where they don't actually have a third party that's reporting to verify that a taxpayer is adequately fulfilling their tax liability, there we know, and this data comes from the IRS's tax gap reports directly, there we know that compliance rates can be under 50%. And so as you think about the ways, and distributionally across the economy, people at the top of the distribution tend to earn income in more opaque ways than people at the bottom of the distribution. And so if you look at the tax gap, you can say that the top 1%, and by the way, the top 1% of the economy is also earning a disproportionate share of the aggregate income that's earned in any particular year over which they have to pay taxes. And so it won't surprise you to learn the fact that the top 1% of the economy is responsible for about 160 billion, or maybe closer to 200 billion adjusted for growth, of the 700 that Mark gave us, which is about 28 to 30% of the tax liability that accrues of the aggregate untaxed tax gap that accrues to the very top of the distribution. I think that's interesting about that is it may very well, it's hard to do these estimates, and in order to come up with tax gap numbers, the IRS relies on random audit studies that it does on the individual side to try to get a sense of the scope of noncompliance. And it tries to kind of piece together on the corporate side and on the partnership side, based on available data and the audits that it does, where noncompliance sits in the economy. This very well might be an understatement of the distribution of the tax gap, because it could be that we're not very good. We know we're not very good at measuring, for example, partnership noncompliance. Disproportionately, partnerships are formed, or partnership stakes accrue to those at the top of the distribution. We also know that people who are at the top have ways even of hiding their income from a random audit. So with offshore bank accounts, let's say, or with or through some of these very complex tiered partnership structures that are just hard to unpack, even if you do get audited. And so all that is to say that this is a problem that is really, and the way the Biden administration has sort of talked about this resource infusion, they've been explicit that as they look to increase audit rates, they're focused on people who are earning more than $400,000 annually. So really, we're talking about the tip of the distribution. That makes sense both based on the distribution of non-compliance, but it also makes sense as you sort of look to our paper and some of what we've already talked about here today, Bob. It also makes sense when you think about where the IRS has lost the most capacity over the course of the last decade, because it's exactly those type of highly complicated audits where the agency has lost the type of revenue agents that are capable of doing that work. And so it's just pulled back from it very substantially. So it's like where the problem is, it's where they haven't had resources to work historically. And it's where they're focused now that they finally have these enforcement resources, which is part of why it's so critical that they retain them.
And just to add to that a little bit, on the corporate side, there's a lot of noncompliance. The IRS estimates maybe about 10% noncompliance rate, but that is probably an underestimate because it's based on their audit experience or actual audit experience. One of the issues the IRS has had with auditing corporations, and Natasha pointed to this before, is that they're auditing fewer large corporations than they used to do in the past. In addition, they are not auditing them as thoroughly as they used to do in the past. And so there are many situations where large corporations may be well advised by lawyers and accountants, take aggressive positions, figuring that the IRS will only find a subset of them. And if they get caught, they may have to pay a little bit, but they have reduced their liability a lot. In addition, in the partnership world, there are situations where taxpayers may have interests in hundreds of partnerships, and they interlock in various ways that makes it very difficult for an IRS auditor to try and put it together. And so that's a tough situation to address. The infusion of resources will allow the IRS to begin to hire, train, and upgrade their overall audit staff so that they can actually do more of this high-income, high-value work.
Now, there are people out there who support defunding the IRS, and when I listen to them and try to figure out where they're coming from, one of the things they say is that strengthening IRS enforcement is going to add to the hardships of everyday, ordinary working Americans by burdening them with just endless audits. And well, I'm not buying that. Your study of audit rates, what does that tell you? I mean, what's the best way to push back against those arguments by looking at data in the audit rates beyond what you've already commented on?
I'll just say a couple of things, Bob. One is I'll re-emphasize that as we think about where these dollars are going to be put to work, the Treasury Department, the IRS, the Biden administration writ large, Congress has been very explicit and clear as they've talked about these investments that really what they're targeted on is high-end enforcement activities. And in fact, relative to historical levels, audit rates aren't going to rise for any American that's making under $400,000 a year. So kind of, I understand the politicization, I understand the fear mongering, but it's just not a reflection of the reality of where the IRS is going to be doing this type of work. But I want to make like a broader point about the importance of investing in tax administration, which is from the perspective of taxpayers who are complying with their tax obligations, what they can expect from this infusion of IRS resources is an agency that's going to audit them less, not more, right? Because part of what's happening as a result of this infusion and this investment in the IRS and in the IRS's technological capacity and enforcement capacity is the agency right now, when it makes audit decisions, it's often like kind of shooting in the dark. Like it like doesn't really have a clear sense of where non-compliance might sit. And so it might sort of bring into the enforcement umbrella taxpayers who have no business there because they're fully complying with their tax obligations already. And so from those taxpayers' perspective, what they can anticipate as a result of the IRS's resources is less interaction with the agency with respect to enforcement, not more. And the other thing to point out, and I actually think the IRS has done like a remarkably good job, and we're in the midst of another filing season, but they did a terrific job last filing season as well, of prioritizing an increase in not just enforcement efforts, but in service efforts. And the result of the IRS's additional resources on these dimensions already is that taxpayers used to experience a 15% sort of pickup rate when they called the agency asking for help during filing season. That went up last year to 85%. The IRS is piloting a tool for direct file with the agency such that you can, rather than spending hours and hundreds of dollars with a tax preparer, you're able to file your returns for free directly with the IRS. Like, there's a lot of innovation here that's happening with respect to making the experience of filing your taxes and preparing your taxes and interacting with the tax administrator a better one for taxpayers. And I think those are investments that the agency is excited to make and that taxpayers are the beneficiaries of in ways that we should all seek to celebrate and preserve, though maybe that's overly optimistic about what the political process will ultimately do in this space.
I think one other thing that the investment in the IRS does, it kind of levels the playing field between compliant and non-compliant taxpayers, where non-compliant taxpayers in the past have been able to get kind of a competitive advantage by not paying their taxes and being able to largely rely on the lack of capacity of the IRS to force them to pay their taxes. And that just gives them a competitive advantage over taxpayers who are compliant, try to want to do the right thing.
Now, the headline of your excellent article promised us two talking points: tax compliance, but also the second part of that, fiscal stability. So not to be a downer, but some of the economic forecasts for the near future aren't looking so great. If we look ahead the next decade or so, I'm hearing some stories about budget deficits of $2 trillion a year. Scary stuff. Given the choice between increasing taxes, which is never going to be popular, or cutting popular programs like Social Security or Medicare that households depend on, doesn't it just make sense to go after the tax gap? Am I correct? Is this the low-hanging fruit of the whole fiscal stability debate?
Yeah, I think that's a good way to think about it. That in the sense of burden on taxpayers and doing things that the American public doesn't like, kind of enforcing the laws Congress passes has got to be low-hanging fruit, right? And as we see on the IRS building, taxes are the price we pay for a civilized society. I think that if we agree on that, then we should agree that taxpayers should pay what they owe under the laws that Congress has passed. And while the investment in the IRA will make a large dollar contribution, we're still going to have challenges in the future going forward with large deficits. I think one of the points that Natasha made earlier is a valid one, that if the IRS is able to successfully make use of these funds, then it becomes a situation where Congress can look at this again in the future and say, hey, maybe we can go back there again and generate some additional funds going forward.
And just to add one point, like something that Mark and I both found like disturbing and was kind of like a motivating factor for revising this paper is in the context of many of the debates that we've had over the course of the last year about the debt ceiling and about fiscal unsustainability and about the importance of revenue raising. We saw some critics of the IRS point to the agency and point to defunding the agency as a way to take dollars and somehow spend less as a government. And that would be like a deficit reduction measure. The reality is exactly the opposite. Like, defunding the IRS makes deficits worse, not better. And giving the IRS the resources it needs to enforce the laws that are already on the books is you said it, Bob, Mark said it, it is the low-hanging fruit in the space of revenue raising that gives us the potential to raise. And again, we're never going to collect all the taxes that are owed, but like if we did, that's 3% of GDP on an annualized basis. That is huge and transformative. And even a small sliver of that, as this paper illustrates, has the potential to make a meaningful impact on our fiscal picture.
There you have it. Again, the article is the Inflation Reduction Act's impact on tax compliance and fiscal stability. The authors are Natasha, Sarin, and Mark Mazur. Thank you so much for joining us. Listeners, you can find the article in Tax Notes. It's a wonderful piece. I encourage you to read it. And we'll see what the future holds in terms of the ongoing debates in the rest of the year and the upcoming election and what's next. But thank you for joining us.
Thanks for having us.
So much.
Want more like this? Subscribe for more tax videos. Special thanks to our executive producers, Jasper Smith and Paige Jones, showrunner and video editor, Jordan Parrish, and assistant video editor, Chris Trigo.